the difference in your output. So you will have, you definitely in a budget, you will have variable cost, fixed cost, semi-variable cost. You will put all that. Now in a flexible budget, you will show separately based on the difference in your production process. Suppose if I'm expecting a production increase of 25%, maybe currently, okay, I have a production of 1000 unit. Maybe I'm expecting that I can have an increase in the production to 1300 or 500. I will put that also into my budget computation. There will be separate cost computation. If my production is 1300 units, what will be my cost structure when my production is expected to be 1000 units? Maybe I can also anticipate the worst condition where my production can go down to 800 units. That also I will include in my budget as separate. So I will have a cost structure if my production is 800 unit. I will have a cost structure if my production is 1000 unit. I will also have a cost structure if my production is, suppose if it increases to 1300 units. So that is the case of a flexible budget. We are accommodating the expected changes at the planning period itself. Okay, so that we know that yes, back to the maximum, this will be the requirement, and to the minimum, this can be the requirement. That's the logic of flexible budget, which is just the opposite of fixed budget. Fixed budget is little more or less rigid, where you expect the best condition based on your past performance. You expect a condition based on your past performance, but you are not prepared a variation to that. But I'll tell you, in the real scenario, when you're going to work in an industry, it's all software based. So every when we are talking about, when we are learning the concept of flexible and fixed budget, this is fine. But from an industrial perspective, when you go into a profession of a cost accountant, all these are software based. So by when you are giving your input, by the time you give your input, automatically your cost structure will be very well, you will get the output. That's how the system is all about. You are going with a specialization in computer applications, so you know it. When you give based on your input, you get your output results, right? So that will happen. But for the time being, for us to learn the concept of flexible budget, we are seeing that this is more or less flexible, which can accommodate the changes. But in a multinational organization, in the real context, almost all the budget and everything remain flexible enough to accommodate the changes that is happening in the economy. They will be having plan A, plan B, contingency plan, disaster management plan, all these, because if it is a well-structured company, they need to have it. It is mandatory, right? So I'm just going with solving an example so that you will know what it is all about, right? In this particular question, the example in front of you, you are given with information of variable overhead, semi-variable overhead, and fixed overhead expenses. And you are asked to prepare a budget of variation of having a production variation of 60% of your capacity as well as 80% of the capacity. So it is normal capacity at which you're operating is, that's given in the question as 75%. It's given in the question here. Now, in case of this flexibility, you have been asked to say that, yes, there can be a change in the question based on your capacity change. Maybe you have lesser demand coming up from the market. Based on that, your production can become 60% of your capacity. And you can also have other condition, which is just the opposite. You have higher demand coming up from the market. So your production capacity can be going up to 80%. So you have a 5% increase, and you can also expect a 15% decrease in your production capacity. So now we are given with only the normal, what we anticipate, that is at 75% capacity. This is actually a concept of fixed budget. Okay, now we are asked to prepare a budget on the concept of flexible budget. So that in that case, you have two other options which will be supporting your budget. Now, looking at the expenses, you know that indirect material expenses, there are indirect labor expenses being given. You're also given with electricity charges, but in that you can see that 40% remains fixed. So that means at all levels of production, this 40% is fixed, whether that be 60% or whether that is 80%, or in the case of 75%, that what we say that expense remain fixed. That's the meaning of that. 60% is variable, which means 60% is variable according to the level of your production. So it will be different for 60% as well as 80%. So we need to find out that. Same with respect to repairs also. 80% is fixed and 20% is variable, which means 80% remains same for 75% capacity utilization, 60% capacity utilization, and 80% capacity utilization. It remains same. The remaining 20%, it will vary between 60%, 75%, and 80%. Now we are given with how we can find out with 75%. We have to go with computation of 60% and 80%. That's all. Now, going with fixed overhead, as we understand, there is no change. This is semi-variable. Part of it is fixed and part of it is variable. But in case of fixed, it is same for all the capacity levels. Say, for example, salary. Salary of a manager will not change even if you operate for 60%. In the normal case, okay? Even if you operate for 60% or 80% or maybe 75%. So that is what we mean by fixed overhead. So salary, insurance, and depreciation will be going with same capacity. And they said as estimated direct wages, it is 40,250 at 75%. Labor hours at 7,500 at 75% capacity. This is for us to find out per unit overhead. That it can be a comparison of labor or it can be a comparison of direct wages, which we have learned in our previous semester, right? So the same principle which we apply here. Now this is actually a working note which we have to do before we go with computation of our, or before we go with preparation of our budget. Because here we are given with 75% capacity, all the information that is related with 75% capacity. Now, what is needed here is we also need the cost structure for 60% and 80% capacity. So one by one, we have to find all of it separately. We need to go with the material cost. We need to find out the labor cost, all for 60, except fixed expense. Because fixed, we know that it is going to be remaining same. It is going to be same for all the capacity level. Other than that, all we have to find out, if 75% capacity, the cost is 1,000, what will be the cost for 60% and what will be the cost for 80%? That we have to find out, right, before we go with preparation of our budget. Okay, so that for that what we are going is, yes, we are given with direct wages at 75% capacity. That's already there in the question, 40,250. Now you know that that is for 75%. So things are very easy for us. What we will do is, what is actually the per unit for 75% capacity? That's why we have done with 40,250 divided by 75 into 60. If 1 rupee is 475, then what is it for 60? That's what we normally do. It's mathematics. So 40,250 by 75 into 60 will give us the wages expense for 60% capacity. In the same way, we can go with finding out for 80%. If 40,250 for 75, what is per unit and what is it for 80? If I have 1 rupee for 75% capacity, how much is it for 80? So 1 rupee into 80. It's the same concept which we have applied here, the cost for 80% capacity. Same logic which we applied for the labor hours also. Labor hours, they have given in the question 7,500 hours for 75% capacity. Now we would like to know what is it for 60% and 80%, because we need, if we have to calculate the per unit cost, we need to have these two. So that's why we went with finding out that. Okay. Now about electricity, we know that certain expense, here they have set the condition as 40% is fixed at all the levels. So we just have to find out, okay, what is 40%? So what did we do? So 37,500 into 40 by 100, which gives us fixed component of electricity, which is same for all the capacity level, for 60%, for 80%, and for 75%. Remaining 60% is variable based on the production capacity. So that we need to find out. We will directly get what is it for 75%. That is 37,500 into 60 by 100 will give us what is a variable component of electricity expenses at 75% capacity. From that, the same way we will go with finding out for 60% and 80% as we did here. If it is 1,000 for 75% capacity, what is it for 60% and what is it for 80%? The same way as we did. So here, when we are talking about fixed, for 15,000 is fixed, which will be same for all the years, for all the capacity levels, and variable component, as they have given, it is in the question. They have said 60%. So we have to go with 60% at 75% capacity level. We get 22,500. From this 22,500, we have to go with finding out for 60% is 80% production capacity. Now, how do we find out? It's very simple. 22,500 divided by 75 into 60, as we did here, into 60, and for 80% it is 22,500 divided by 75 into 80. If one is for 75, how much is for 60%? That's it. Okay. Same repairs also taken like that. It has been said that repairs 80% is fixed. Okay, 80% is fixed, which remains same for all the capacity levels, 60% and 80% capacity level. So 3,750 into 80 by 100. This 3,000 will be same for all the levels, 60%, 75%, as well as 80%. Now, variable we will get for 75%. From that, we need to find out for 60% and 80%. Now, how do we find out for 60% and 80%? It's very simple. 750 divided by 75 into, if we are finding for 60%, it will be into 60. If we are finding it out for 80%, it will be multiplied with 80. Okay, this is the working note which we have to keep ready before we start with preparation of a flexible budget. Now we are going to prepare it. Okay, now the procedure is same. Only thing is that you will have two more extra columns. One column for 60% capacity, another column for 80%. The format remains same. Okay, so this is it. Here you have the format as variable, semi-variable, fixed at 60% capacity, at 75% capacity, which is given in the question, and at 80% capacity. This is why we call this budget as a flexible one. We are expecting that our output can be little flexible. Okay, based on our past performance, based on the current market conditions, we expect that our budget can be flexible enough. Little maybe by reduction in the demand, or it can cause an increase in the demand. When we are manually working it out, all these things become little lengthy process. But if it is software based, you just have to give the input of these two. It's already done. When you are in an industry, you just have to give, okay, your production capacity is at 60%. Straight away you will get all these. But we need to know the logic behind that. That's why we are manually working it out and try to understand that. Right. So variable overhead with respect to indirect material, it is very simple because it's already given in the question. Indirect material, it is 7,500 for 75% capacity. Now we can go easily with 60% and 80% capacity. How do we go with 7,500 by 75 into 60? That will give us for 60%, same as that. It will be like 7,500 by 75 into 80% for 80% capacity. Same the case with indirect material. How do we go with 22,500 for 75%? Now we need to find out for 60% and 80%. Things are very simple. Just listen to me very carefully. Okay. So we are given with 75%, that is 22,500. Now we need to find out what will be the cost structure if our production capacity is reduced by 15%, that is at 60%. So how do? We will find out for one unit and then multiply it with 60% capacity. So we are going to find out what is per unit labor cost if it is at 75% capacity. So 22,500 by 75 into, we will go with whatever it is. If it is for 60, we will multiply with 60. If it is for 80, we will multiply with 80. Now, in case of semi-variable, as I said, one portion is fixed and the fixed portion remains same irrespective of change in the level of output, irrespective of change in our output capacity. Right. So that is why this fixed component remains same for all the years, 15,000, 15,000 and 15,000. Now we know that the remaining is flexible enough. So we need to find out what is it depending on our output capacity. So for we are given with 22,500, we found out for 22,500, but we can easily find out for 60% and 80% from that. Now how do we find out? 22,500 by 75 into, if it is for 60%, it will be 60. If it is for 80%, it will be multiplied by 80. Okay. Same case for repairs. Here the repairs is 3,000. It is fixed component is fixed for all the production levels. Variable, it will change from different capacity level. 75 we already had. We could easily work out from what is given in the question. Then we are going to find out for 60% and 80%. How do we find out? 750 divided by 75 into 60, and for 80 it will be multiplied with 80. Now, as I said, fixed overhead, there is no change. So fixed overhead remains same for all the capacity level, that is our salary expense, insurance expense and depreciation, which is already given in the question. We did not do any further classification for that. Now what are we doing? We are totaling up the cost, which will be variable overhead plus semi-variable overhead plus fixed overhead. And we get the total as 1,90,600 for capacity level 60%. For capacity of 75%, we are getting 2,01,250, and at 80% capacity, we are getting 2,04,800. This is it. But in the question, till there we have prepared the flexible budget. Now what we have to remember is there is one more question which is being asked: find the total overhead rates. Right. Now we need to find out the overhead rate, total overhead rate. That's there. They asked us to prepare a flexible. That's somewhere you all will make a mistake. You will straight away find, okay, it is flexible budget. I'll prepare a flexible budget. Yes, I finish. You will close the question and go. But remember, if there are two questions in your main question, two answers expected from you, you will get full marks only when you do both, when you solve both. In this case, the first one is the one where you prepare the flexible budget, which carries majority of the mark, but definitely there will be 20 to 25% mark which will be given to this overhead rate. So if a student has prepared the correct answer for the flexible budget, still he or she will not get the complete mark if this is not answered, if the second part of the question is not answered. So read your question properly, because I find always these mistakes in the question paper. Because for a student who is academically good, flexible budget preparation is an easy question that can be asked for the direct question that can be asked for the university examination. So as you find this, you will start doing that, prepare that, finish it off. But remember, there will be subdivisions to the existing question. So in this also, we have a subdivision, that is total overhead rate needs to be found out. Now, the technique which finding out the overhead rate, we had done in our previous semester. That is, it can be either by comparing it with direct wages, or in this particular context, there are many other ways of finding out the overhead rate. But in this particular context, since we are given with direct wages expenses as well as direct labor expenses, it is understood that we have to find out the overhead rate based on comparing with direct wages and labor expenses. That's what we are going to do as our second part. That is, here overhead rate is equal to what we do, overhead divided by direct wages. It's already there for every category. We already found out here direct wages 75%. What is it? 60% and 80% capacity. We found out that at the beginning. So it's the same thing which we are making, which we are comparing. So it will be 1,90,600 divided by the capacity is 60%. Remember, the capacity is 60%. So at 60%, we will have to look up what is our direct wages. So 60% capacity, direct wages is 32,200 into 100, which will give us overhead rate at the 60% capacity. The same method is used for 75% capacity and 80% capacity. Right. Now we have one more comparison that could be made based on the labor hours. So here the denominator will be labor hours at 75% capacity for computation of labor overhead rate for 75% capacity. In 60% capacity, the labor hours at 60% capacity will be the denominator. 80% capacity, same the way as we said for the previous one, labor hours for 80% capacity will be the denominator. We get the rate. That's it. So flexible budget is all about accommodating different capacity levels, so different activity levels. The changes in the activity levels are being incorporated into your budgeting technique. Then we say that that is the concept of flexible budget. As I said, in the real scenario, almost all the companies, they will have a flexibility in their budget structure, because that is what they will be doing for every quarter. Another thing which you have to remember is, based on the changes in a particular quarter, the company will also be thinking of accommodating that while preparing the budget for the next quarter. Because if we plan properly, it will be that our output level or our capacity level or our operational efficiency will remain as expected. That's why they plan it very correctly, more or less near to the real market condition. And every company will be having like plan A, plan B, or as we say, what is a contingency plan if they face with some kind of calamity or some kind of internal problems or loss, huge loss due to stock lost in transit or due to fire. They plan for it. A good company, a systematic company, will always be planning for it, and they will accommodate that in their budget structure. Okay, that is also incorporated in the capital structure. They will have a reserve fund, which we learned in accounting, to meet these contingency event, to overcome these situations, right? So this is one type of flexible budget preparation based on the information given. Because in this question, we were given with information as variable, semi-variable, and fixed overhead. Right. Now, there is a pattern difference, which I am going to discuss it now itself, and later you can start working on this. I'll share the question with you. Based on the pattern difference, because we had been preparing a budget like cash budget, we were looking into the receipts and payment. Same as the way here also you can have that concept of receipts and payments. So that is something which is given in this question. See, you can see that in the question you are given with receipts, the actual for 2018 and the expected or the pre-planned one, prospective plan for 2019. That is how they have given in this, but the pattern is a little different. The previous one, we had the cost being categorized into semi-variable, variable, and fixed. Here, it is more or less like receipts and payments. concept, right? So here, from the following information relating to 2018 and condition expected to prevail in 2019, prepare a budget for 2019. So we have 2018 figures with us. We are asked to incorporate the changes and prepare a budget for 2019. Okay, that is the scenario which we are going to scenario in which we are going to prepare the budget. We have the actual with us. We are going to plan it based on the present one for the for the next quarter or next year, right? So this is never a zero-based budgeting. Why? Because here you have a base. We learned the concept of zero-based budgeting, where we said that we are not looking into the previous one to prepare the next one. We are starting at scratch. That's what we learned in zero-based budgeting. But here, this is not zero-based budgeting. This is base year is being the previous year, the previous operating cycle, which is used. The previous receipts and payments are considered when we are making payment, when we are preparing budget for the next year. Okay, that is what we are going to do. Now, while observing, you can see that you're given with the receipts, sales, and also the expenses, other expenses connected with that. Variable overhead, fixed overhead, you're given with the raw material expenses, wages expenses, right? Here, the particular thing what we can do is we will be in a position to find out the profit or loss also. In the previous question, we were not given with the receipts part. So we were able to prepare only the total cost, the total overhead. But here we will be able to compute the profit also, because receipt, sales minus other expenses, we will get profit for that particular period. So that is also possible in this particular question that is given to us to solve it. Right. So when we look into the prospective, we can see that the sales revenue is becoming 1,50,000 because they are expecting an increase in production units. In the previous period, it was 2018. In this period, we are going with an increase in the production capacity with 60,000 units. Accordingly, that will be reflected in your sales value also. So that is a primary difference. Now, since there is a production increase, automatically your material cost and other cost is going to increase, right? So that is why here we can see that there is a cost in the of course, it is next year, so the price increase can happen, raw material price can increase. So it is being said there is an increase of 5% price increase in the 2019. Now, how do we do 5% price increase? It's nothing but here. It is for 40,000 units, we have 53,000. So it is very simple. I can easily find out for 1,60,000 units with 5% increase. For that, what I have to have is, I need to have per unit price here. So what do? I will do 53,000 by 40,000. Then I will have per unit price at that quarter. And then I know that I need to find that for 60,000 units, but there is a percentage increase also. So it will be 40,000 by 53,000 into 60,000 into 105 by 100. I'll show you how it is. 105% by 100. Why? Because there is an increase of 5. You can divide it, okay? It's not mandatory that you have to do in one step. I just told that. Otherwise, you can do like 53,000 divided by 40,000. You will get for how much is the per unit raw material cost for 1 unit. If the production is 40,000, for 1 unit, what is it? Then straight away we can go with 105% of that, because it is said that in 2019 the raw material cost is going to increase by 105%, by 5%. So it will be if suppose if you get 1 rupee as the raw material per unit cost for 2018, it will be 1 into 105 by 100. Right? I have 100% with me. I need to find out 105% for 2019. So it will be 1 into 105 by 100. And then I get per unit cost for 2019. Now I know that I have 60,000 units. So I need to find out the total raw material cost. So it will be that into 60,000. The amount which I get into 60,000. So that is something which I said at the beginning in one single step. You can choose what you want, but that is how we go with each of these cases. Like wages also similarly, I will take 11,000 by 40,000, I'll get per unit. Then I know that there is a 10% increase, so I'll go with that one. Suppose if per unit in this case is 1 rupee, then it will be 1 into 110 by 100. I will get what is the per unit cost for 2019 into, I know that the number of units produced will be 60,000. So into multiplied with 60,000 units. Same here also. 5% increase in productivity, and again, what I have to remember here is they have gone with one more plant of 25,000 and drill of 12,000. So there is a new plant purchase. Okay, so if you want, you can also accommodate for depreciation, because generally when there is a plan, we will also accommodate for depreciation that is going to happen in that particular year as one of your expense. That could be accommodated anticipating a real market condition, and for planned it is 10% as per the rule. So you can accommodate for 10% depreciation also, since they said there is a purchase of land in the year 2019. There is an expected planned purchase in the year 2019. So you know that by the end of that period, you're going to have a depreciation of 10%. That can be shown in your answer to be very near to the actual situation. So this is what here in this case, it's not actually the flexibility what is answered. You are actually looking into the previous period to prepare a budget for the next coming period, the next operating period, maybe the next financial year. That's what you do in this particular question. See, this is how it happens. You have a sales. We know that actually in 2018 it was 40,000. Now in 60,000 units is in 2019 you expect 60. Okay, 60,000 units. And you know that the sales, it's already given in the question. The sales revenue for 40,000 is 1 lakh. The revenue for sales for 60,000 unit is 1 lakh 50,000. This given in the question. So we just carrying it to our question answer. And then we know that raw material cost 53,000 for 40,000 units. I said the method. The method is nothing but first we find out the per unit cost of raw material at 40,000. Then we know that we are anticipating an increase of 5%. So what we do? That into 5 by 100, which gives us the per unit cost at 2019 multiplied with 60,000, we will get the total raw material cost. Same as this way, we will compute for wages and variable overhead also. But fixed overhead, we need to remember that that will be same for both the period until otherwise there is a change that is being mentioned in our question. Okay, here it is not mentioned, so we take that 10,000 for both these periods. Now, as I said, no, we know that there is a purchase, additional planned purchase, which has happened in the 2019 period, which is going to happen, has not happened, which is going to happen in 2019. So we know that when there is a purchase, automatically depreciation is part of that, and plan generally is depreciated at 10%. So we will accommodate a depreciation of 3,700. Now, how did I get? It's very simple. 2,500 into 25,000 into 10%, which gives me 2,500. 12,000 into 10%, which gives me 1,200. So 2,500 plus 1,200, which the total of my depreciation will be 3,700. I get this 3,000 here. Now I have the total of both these. Now it is very easy for me to find out whether I have a profit or loss. That we have learned already, right? That is sales minus cost, which gives us the profit. In this case, it is profit, because sales minus cost of production, sales is positive, it is higher than your expenses. So in both the cases, we are making profit. Right. So I hope you have got a picture of flexibility in preparation of budget. Basic logic is you are trying to accommodate the changes in your activity level when we are going with the budget preparation. You're not keeping it fixed. You know that there can be a variation in your production capacity for the coming quarter or for the coming financial year based on the changes happening in the market. So what you expect is either you can have an increase in your production capacity or you can have a decrease in your production capacity. In our first question, we dealt with these three conditions where it has been said that we can have a 60% production capacity, or we can have a 75% production capacity, or 80% production capacity. So we prepared a flexible budget for these three periods. Now going with the next, we were looking at preparation of budget for the coming financial year based on the previous financial year. That is why we had the actual in hand. It is completed. So we have the actual in hand, that is 2018. Based on that, we are going with the preparation of 2019. So that is where I said the concept of, it is not the concept of zero-based budgeting, because here the base year being considered for the preparation of next year. Right. So there we really have to remember that all our expenses need to be accommodated with the changes that is going to happen in the current coming financial year. Right. So in the question itself, we said there is an increase in the wage and raw material cost, which needs to be accommodated in the expenses. So that's how we prepare the flexible budget. Okay, now we are going to do this.